Afternoon, my friends. So, since I just recently covered CVS, the obvious next question somebody had for me was, what about Walgreens? Now, I happen to have shares of Walgreens, quite a few, and some of the recent issues have caused me to be in the red. Now, being in the red is a little bit deceptive in the sense of, along the way, a lot of options were sold, cash secured puts that didn't get assigned, some that did, which is why I have shares, a lot of dividends collected. And so being in the red price wise isn't exactly representative of the actual, total return of the position if you factor those things in, right? But that being said, it is still showing some red, and I'm looking at it from two perspectives. One, was my cost basis, still within the realm of reasonableness? And two, does it present a good opportunity today to either enter for new investors or to lower my basis? Now, I'll answer the second question. I'm not right this moment working on lowering my basis just because it's a pretty full position, and I think there could be better opportunities that I'm able to identify. So I'm not in a hurry to concentrate further into Walgreens, but I may reconsider as I continue to stay up to date with their situation. Now, Walgreens has historically done a reasonably good job of growing the business over time, and granted, they've gotten really big, and as a company gets bigger, it gets harder and harder to grow it at a higher rate of speed on a yearly basis. However, with Walgreens, you also have a recent history of buybacks. So they've started to, cut that share count down a bit, which means while they're at low multiples, you receive a bigger piece of that pie, though it's slower growing, right? Now, they've struggled a little bit with their gross margins, okay? Gross margins used to be in the mid to high 20s at different points, and they've been pushed down into the low 20s. They bottomed at right around 20, and they've bounced back up a bit to just over 21. And when you're dealing with a company that does over $100 billion in revenue, every percentage point of gross margins translates into, like $1 billion on the bottom line. So this is, while it looks like small potatoes, the fluctuation in gross margin, it's actually one of the biggest deals for the business. Now, retail, it's no secret, is facing some issues. It's also no secret that Walgreens has had to pay out some money due to litigation in recent months. All retail is struggling right now as well. Now, the various issues that have been plaguing Walgreens actually, honestly, are also being faced by companies like Walmart, who, they're a retailer and they also have, a pharmacy division. So, honestly, it's not just specifically Walgreens that's being hit with a lot of these different struggles right now. And the question you have to ask yourself is this going to last forever? And can Walgreens survive it? Now, I think it's not going to last forever. And yes, Walgreens will survive it. This is a pretty high quality business, and they've been around the block, okay? This isn't their first rodeo. All right, there's been recessions before, okay? And Walgreens was around then, and it's still around today. And I think they'll be around 10 years from now. I don't think that's going to be... I would be absolutely floored if Walgreens was gone 10 years from now, right? So, how do we determine if we're in the realm of sanity when it comes to valuation? Well, I think, first off... All right. So if I'm actually gonna show you the analyst estimates on the data feed for stock analysis. I sometimes look at other data feeds, but since they've got this one conveniently right here, we'll look at it. Now, I'm not interested in these price targets, okay? I just want to point that out right off the bat. These price targets, I basically ignore them, okay? Because what you need to do as an investor is come up with a fair valuation that makes sense to you and for you, okay? So what you do want to look at, though, is what their projections are, especially short-term ones, regarding things like earnings, okay? Because even if like the price targets are kind of just, whatever, I think the analysts do work closely with the company, and especially short-term earnings estimates tend to be at least somewhat in the, ballpark of accurate, right? So this year, at least according to the data feed on stockanalysis.com, they're projecting $4.57 worth of EPS. So when we do our discounted free cash flow, we can use that as a starting point, okay? Because, all right, it's short term. It's just we're talking about this year. So the chances are the analysts will be pretty close, okay? Now, I've taken the liberty of plugging that in already into the DCF calculator and assuming extremely low growth, like we're talking in the realm of long-term inflation level growth, when honestly the analyst estimates for growth from 2024 onward are quite a lot higher. 6%, 9%, 9%, 6%, right? So we're going low side on the EPS growth. So we're making a conservative assumption, okay? And what do we get for a fair value using, again, a conservative 12% discount rate, where the standard might be something like 9 or 10? We come out with a fair value of close to $42. Now, that's with that steeper discount rate and these very conservative assumptions. Now, my cost basis is pretty close to this. I think slightly less than this number. So that's why I'm still comfortable holding the stock, because basically this calculation says that if you pay $42, you would get about a 12% return annually over the next 20 years. I can live with that, even if the current price today is $29. And, if you bought it at today's price, well, you can just up the discount rate until you get closer to today's price. And, these assumptions tell you would probably get something like an 18% return buying in today's price. So, hey, sometimes it pays to be patient and wait for stocks to go down to buy them, huh? So you might be asking why I'm not deducting the tangible book value. So I discussed this a little bit in the CVS video, but with Walgreens, a big chunk of their liabilities are likely to do with their lease obligations, their long-term lease obligations. And frankly, counting that as just like the same as debt, it doesn't really strike me as fair, because it's more it acts more like a monthly expense more so than a debt in a lot of cases. So, and the accounting rules around it, to my knowledge, used to be different than they are today. I don't really care to get into an accounting argument, but suffice it to say, I think that the sum of the cash flows and earnings is more important than how they account for their lease obligations on their balance sheet for a company like Walgreens, okay? Because if they, for example, owned all their stores and just had debt against them, that would probably negate this, right? But they choose to lease them instead, and I'm sure there's different business, probably so that in the event that they need to close down a non-producing store, they can. So without getting too much into that, I don't think it's reasonable to penalize them on tangible book value. Now, There could be a different way to run these numbers where you do that and you still come out with, a reasonable fair value compared to today's price. But this is how I think of the company. And frankly, I think today it's probably a pretty screaming deal. But that's only if you believe that the current issues with the company and with retail in general are most likely temporary, and that they will get through it and survive and be around in the next 10, 15, 20 years. If you think that, then yeah, this is probably a pretty good deal at the moment. However, will analysts be right about how much the EPS grows over the next few years? Well, we don't know that, which is, again, why we used more conservative numbers than the analysts in our model here. So that's just my take on Walgreens, and that's the reason why I can sleep at night with this thing in my portfolio. I don't think they're going anywhere, and frankly, the issues facing them are not necessarily unique to them. And certainly, large, high-quality companies like Walgreens, Walmart, etc., they'll still be around in 10, 15, 20 years. So that's really all I got to say about that. Go ahead and do me a favor and like it if you liked it. Comment below if you have any Walgreens in your portfolio. Smash the subscribe button if you want to see more. And hop on Discord. Link will be in the description. And remember, everybody, there's no such thing as a product. Don't ever think there is. There is only sex. Everything is sex. So saith Robert California. Take it easy, everyone.